Hi, everyone. This is Kim Lochridge from Engineer Tax Services. We are launching our Possibilities webinar series, and we've got a series of webinars to show you some of the possibilities that we can incorporate for using tax incentives. And there's just a whole series of things that we're going to be covering. These are all going to be recorded so that you can refer back to them. They'll be listed on our website at www.engineeredtaxservices.com. So without further ado, we're going to start today's webinar of how to use tax incentives to fund your next investment. So with that said, I'm going to start moving forward with the slides and introduce myself. I am the Executive Vice President of Engineered Tax Services, and I've been with the company for about 14 years now. Personally, I'm on the tax committee for the Real Estate Roundtable in Washington, D.C., and that is the country's largest real estate lobbying group. Our company is also on the R&D Coalition, the 179D Coalition, and we're very well connected on Capitol Hill for these types of incentives. And we'll talk a little bit more about kind of what Engineered Tax Services does so that you can familiarize yourself with that. I'm also on multiple board positions. Personally, I've been a real estate investor since the late 90s. And not only do I kind of live and breathe some of these tax incentives, I also incorporate them into my own portfolio. So I have a lot of experience with what you all are experiencing, whether it's a small business or real estate, passive, active investing, distributions, syndications, those types of things. And I can help in that arena as well. I have over 32 years in finance and accounting. I am a multinational speaker all over the world. I've done presentations to help those individuals, with the tax incentives or specialty tax products. So a little bit about Engineered Tax Services. We are, our Engineered Advisory is kind of the umbrella company. And then we have Engineered Tax Services, the Growth Partnership, Inside Public Accounting, and Able Software. We also own the Rosenberg Survey, which is a very large CPA benchmarking survey, which is also what IPA or Inside Public Accounting is as well. So we have a lot of insight. If you are a CPA and joining our webinar series, please stay close to us in regards to the Rosenberg and the Inside Public Accounting reporting. If you want to be a part of those, those benchmarking studies, we would love to have you participate. And we're ranking all kinds of different things that happen throughout the firm so that you can benchmark yourself and compare against other firms in the country. So it's very, very helpful. A little bit more about Engineered Tax Services. We are the national leader of specialty tax. We have about 150 employees with tax attorneys, engineers, and CPAs on staff. We are nationally oriented, so we have offices all over the country. And a lot of times, people want to go with, say, a cost seg provider or something like that, and they want to use somebody who's local. Our engineers are strategically located around the country so that we can be within any property, kind of within an hour or two. So we don't have a lot of travel costs associated with these. So it is like using somebody in your backyard without having to have the excess fees. So those things are quite nice. And a lot of people don't know that. We've been in business since 2001. So we're going on our 22nd year of being in business, and on services that we provide are, basically anything in specialty tax. To the right, you'll see some of the lists of the cost segregation, the tangible property repair regs, repairs and maintenance reviews. We do partial asset disposition studies, property condition assessments, research and development tax credits, state and local incentives, ERCs, all kinds of different strategies to help with tax savings. So this is a very important role for us, and we believe that everyone should pay tax, but there's nothing in the code that says you have to leave a tip. And our job is to help you and help your clients take the tip off the table. Okay, so with that said, the learning objectives today, we're going to touch very briefly on some of these. Now, we have more in-depth presentations on each one of these on our website. Cost segregation, 179D, 45L, if you don't know what that all, we're what that is, we're going to just do a quick review. We're going to talk about the employee retention tax credits, research and development tax credits, and grants. And we're just going to briefly touch on some of these things as to what they are, just to pique your interest. And if you want to learn more about them, you can go over to our website and hit those webinars that are more in depth of each one of those service lines. But today we're really going to focus on, as a result of some of these incentives, what are the possibilities that you can do with that, and how are those going to benefit you? Okay. So the first thing we're going to talk about is cost segregation. So cost segregation is a study that is a process of evaluating commercial or investment property to identify between real property and personal property. So, essentially, if you were not going to do a cost segregation study, you bought a piece of investment real estate property. Now, this could be a long-term rental, a short-term rental, it could be a commercial building that you're renting out, could be self-rental. Maybe you bought the building and you're using it, you're renting it back to or from your LLC that you own, so it's common ownership. It could be just a variant of different things, maybe even triple net leases. So essentially, if you don't do a cost seg study, your CPA is going to put that property on a property schedule for depreciation for 27.5 or 39 years. And that is dependent upon what type of property it is, to what bucket that should go into. When you do that 27.5 or 39 years is called straight line depreciation or standard depreciation. Essentially, it's kind of like your standard deductions on when you're filing your taxes, right? So if you're going to file a 1040 EZ, you've got 1 or 2 pages of tax return that you need to file. And essentially, you can do that very quickly on a calculation, and you just get a standard deduction for doing that. But when you do a 1040 per se, the 1040, takes a little bit longer. You have to itemize your deductions. Typically, you have to get a CPA to help you, and it costs a little bit extra money, but it's worth its weight in gold, because you're able to itemize the deductions and you end up getting more, taxes back, or pay less in taxes as a result of filing that versus just taking your standard deduction. Well, cost segregation is the same thing. Cost segregation is the itemized depreciation for that property. So instead of just taking your standard depreciation, we're going to itemize the building, and we're going to break out the assets, carve out from 27.5 and 39 year, and we're going to put some of those assets into faster class life, like typically 5 or 15 year buckets. That's super important because then you actually get additional depreciation. And of course, we'll get into what the bonus depreciation is and how that works. So as a definition, we just want to explain that essentially this is going from a standard depreciation to an itemized depreciation for your building, and it gives you more deductions. So there's a huge benefit from that. This slide will indicate kind of the difference between that. On the left, you have a building in whole where you're depreciating it on straight line. Everything that you purchased goes into that, obviously minus land. And then the slide on the right is reflecting what types of things that we can break down when we're doing a cost segregation study. Cabinetry and countertops and flooring can go into, say, a 5-year bucket, whereas things like landscaping, curbing, gutters, parking lots, driveways, signage, fencing, that can all go into more of a 15-year class life. And when you're buying a building, it's important to know where those assets belong so that you can take those itemized deductions on the building. So why would we do this? Why would we do a cost segregation study? First of all, it yields accelerated depreciation, and we'll talk about the bonus depreciation rules slightly about this, but it really, a cost segregation study actually falls within the IRS's preferred method of depreciation. Their preferred method is the MAKERS. The makers is the cost segregation, where you're breaking out those assets. And the straight line depreciation is so vague. Obviously, they're not going to fight you because you're not taking enough depreciation. But if they had their ruthers, they would want you to do the maker's methodology, which is outlined in the audit technique guidelines. So to fall within the IRS's preferred method of having all of those assets broken out, it's much easier to track, and it's much more indicative of what's really going on in the building, especially if you have, say, a roof replacement soon after, okay, or something like that. Anyways, also we want to optimize annual write-offs, and that accelerated depreciation gives us more upfront. And so therefore we actually reduce the tax liability that we have, and we're able to pay less in taxes, which in turn gives us the possibility of doing other things. So also why cost seg is to optimize annual write-offs. Once you have a breakdown of the building, you might do some improvements after such, and then you can optimize those improvements with, some partial asset disposition or potentially some repairs or routine maintenance, right? So if you have those broken out, it's much easier to optimize the annual write-offs. The retirement of assets, which is also partial asset disposition or demolition. So in the event that in the future you're doing any improvements, the cost segregation is very helpful for that. And it also can reduce recapture upon the sale. A lot of people have a myth that you will have recapture, and that is true in the case where you do a cost seg study, and especially if you take bonus depreciation and then you sell that property a couple years later, you may have some recapture to pay, but there are a lot of things that can help you reduce that recapture, such as the partial asset disposition. You're writing off those assets, disposing them so that you're reducing that accumulated depreciation. Lots of information there on that, and we'll get into detail of those in the other cost segregation presentation that we've done on our website, but this is just to kind of whet your appetite a little bit. And then, of course, bonus depreciation. So a lot of information, a lot of reasons why to do the cost segregation. Where is cost segregation a good fit? Pretty much anyone who owns commercial or investment real estate, and they are paying tax on that income. Regardless of where you own it, it could be active, it could be passive. If you're paying tax, this is going to be, a crucial tool in your tool belt to make sure that your finances, and the way you're structured is the best and most tax efficient. So cost segregation, it would be new construction, any kind of renovations. If you're doing renovations, typically over $50,000. Existing properties. So if you've owned a property for 4 or 5 years, it's not too late. You can still go back and do a cost seg study, and you don't even have to file an amended return. A lot of people are unaware of that and think that they missed the window of opportunity because they didn't know about cost seg. Recent or new acquisitions, obviously, if you just purchased a property, that'd be a great time to do it. Leasehold improvements, if you have those. Anytime there's a inheritance or a step up in basis, maybe you sold a partnership to somebody or you bought a partnership, that would be a great opportunity to do a cost segregation study. 1031 exchanges, anytime you have an excess basis, that is very, very helpful in doing another cost seg study, because you can still qualify for the bonus depreciation. And selling a property with large gains. So we can actually do a reverse cost segregation study. And this is one of the things that we can specialize in when we're doing that. Essentially that's another whole nother presentation on the details. Quick question that I had in here was that does the cost seg benefit ultimately go against personal income or tax liability? It can. If you're a real estate professional, or if the income from the property is, active, then obviously it can offset your personal income and your tax liability. Even if it's passive, or if you're investing in, a syndication and you get a K1, if you had the tax cost segregation study done, then you essentially can, take the depreciation through your K1 and that flows through to you. It just depends on where it lands on your, in your financial picture. So, so hopefully that helps. And we can certainly chat about that a little bit later. If you have questions, Eric, you can reach out to me directly. My contact information is on our website and also on the end slide for this presentation. So the bonus depreciation is extremely powerful, and I'm bringing this up because I have also a quick slide in here that's just an example. Bonus depreciation is beginning to phase out. A lot of people think that bonus depreciation or they think that cost segregation is going away because bonus depreciation is starting to sunset. But I will let you know that cost segregation is not going away. Cost segregation has been around since the 1940s. So we still have the opportunity for bonus or for cost segregation. The bonus depreciation actually started in 2006, believe it or not, but really started getting traction because it was increased to 100% during the Tax Cuts and Jobs Act of 2017. So, it was there. And once it was written, then we started having this phase out, which in 2027, the bonus depreciation is gone. But this actually applies to any assets that we reclassify. So we talked about reclassifying assets from that long-term to, shorter buckets. So any class life that's 20 years or less counts and is qualified for bonus depreciation. There are some exceptions to that rule, of course, but and we'll get into that, in our deep dive on cost segregation. But this would be really good opportunity, and I'll give you kind of an example of that. We have a lot of investors right now using bonus depreciation as a tax strategy. So yes, we have some recapture. If you take that bonus depreciation, think of it this way. I like analogies, and hopefully they help you visualize exactly what I'm trying to articulate. But think of bonus depreciation as kind of an advance on a paycheck, okay? So if you go in and you start a new job and you say, Mr. Boss, I'm going to work for you for 5 years, and I want you to pay me 5 years up front. That's essentially what bonus depreciation is. And if you quit that job in year 3, you're going to have a couple years to pay back, okay? So bonus depreciation is kind of like that. However, there are some things that you can do to have to not have to pay that back, which would be what I refer to as recapture. And that is through maybe doing a 1031 exchange. You won't have to pay that recapture back. It rolls over into the new property. So you get to keep those benefits in your pocket. So there's a lot of things that you can use. Think of cost segregation as a tool in your tool belt. And if I had only a hammer to build a house, my house probably would not stand up for very long, right? I would need other things like levels and tape measures and saws and things like that to build this house. Lots of tools. That's the same as your financial picture. In your financial tool belt, you need to incorporate lots of different tax strategies or tools in that tool belt. So, using just cost segregation, but then not using the benefit of a 1031 exchange or something else to offset the recapture is like building a house with only a hammer, right? So we want to make sure that we're building a financial picture for you, and making sure that if you do incorporate, say, use the hammer, that we're going to back it up and we're going to end up putting some nails with that, right? And we're going to have a saw and we're going to have some other things. So that's what ETS can help you and your CPA with, is creating these financial strategies. So bonus depreciation as a tax strategy, some people use the bonus depreciation in lieu of a 1031 exchange. If in the same tax year they sell a property and then they go buy another property, they can use the bonus depreciation from the new purchase to offset the capital gain from the sale without having to do a 1031 exchange. This is key if you maybe miss a 1031 exchange. Say you're going to do a 1031 exchange, but you miss the 45-day identification period. All is not lost. You might be able to still be able to offset that gain with your cost segregation from your new purchase. Lots and lots of strategies to be able to keep this tax deduction in your pocket, to be able to use these for possibilities of other things. I'm not going to deep dive into the partial asset disposition and on this slide, but I wanted to get you to kind of an example of cost segregation. So I know there's a few acronyms here or abbreviations, so I'll spell that out for you. Say hypothetically, I purchased a $1 million property last year in 2022. Okay. Let's call it net of land. We know land is not depreciable. So let's just say net of land, I paid $1 million. If I was to put that on a commercial property, 39-year schedule, I would essentially get about $25,641 in depreciation every year to offset that. Now, my income, hopefully on that property is more than $25,000. So I can, let's say I have $50,000 in income, then I can use that, and I'm paying tax still on 25,000, right? That's how that works, because the 25,000 will reduce that income. And that goes on for 39 years, right? It's just the normal depreciation that you can take on straight line. When you do a cost seg study, and assuming I am eligible for the 100% bonus depreciation, which was in 2022, we can safely assume that we're going to reclassify about 30% of that $1 million. And that is 100% bonus. So that means that when I have a 5 or 15-year tax schedule, if I put it in 5-year buckets or 15-year buckets, I don't have to wait 5 or 15 years for that. Because of bonus depreciation, it applies to my buckets that are 20 years or less. So in that event, I actually get to take all of my 5-year, all of my 15-year upfront, and I take a tax deduction in the first year of $300,000. That's a big difference between the 25,000. So if I have, let's say hypothetically, I'm still at my $50,000 in income. Hopefully it's more than that, but I still have $50,000 in income on this property. Essentially I don't have to pay tax for about 6 years, because that 50,000 comes off the 300, and then the rest of it, the 250, rolls over to next year, and then I offset that. So for 5 years, I don't have to pay tax on this. And then what are the possibilities if I had an extra $50,000 in my pocket for, and depending on your tax rate, could be 25, could be 30, whatever that tax rate is. But, what could I do? What are the possibilities for me to do with that extra money each year, so that I can help, make more money if I can reinvest that? And we'll talk into that. We'll talk about those things a little bit later in the slides as well. But, also, one of the myths that we have with cost segregation is that if I take all of the depreciation up front, I'm not going to have any other depreciation in future years. And this will show you that in the case that even we do take the bonus depreciation up front, say $300,000, you still have depreciation of about $17,000, or basically $18,000 if you want to round it up. Every year after that, you get to keep adding to that $300,000. So that could be very, very powerful. And I had a quick question if this would work on a second home or only income generating assets. That's true. It does have to be an investment property, which means that you need to have, if it's a second home, you're not earning income on that usually, right? You're just using that for your second home, and that's not depreciable. But if you say turn that home into a short-term rental when you're not using it, and then it actually goes to, an investment property, you get to start depreciating that asset, then yes, you can do a cost seg study and offset some of that income from there. There are some rules around passive and active, and let's discuss that. But yes, we can do this for any income producing property. Can you 1031 vacant land sale and foreclosure or purchase? So vacant land is not depreciable, and so you don't depreciate that, but you can 1031 exchange into or out of a land deal. Okay. And then one other question, and then we'll move on, is can you use the strategy to turn your home into an income rental property? Yes, absolutely. That's called house hacking. So house hacking is, something where you live in maybe the upstairs and you turn the downstairs into an Airbnb, and you start renting that out. Then you can start depreciation a portion of your home. And one other question. So if I sell property in one LLC, can I do a 1031 exchange and buy a new property on a new LLC? Yes, you should be able to do that. And there are some caveats to that. And so if I house hack, can I do a cost seg on it? Yes, you can. You will only take a portion of it, but you certainly can do that. So thank you for the questions. And I really appreciate the interaction. It's very helpful. Okay, so we're going to move on very briefly about 179D and 45L. Some of these things, like I said, I'm going to touch base briefly because we do have a full deep dive into this. Typically, these are energy incentives that are for usually new construction on either commercial or residential properties, typically multifamily. So if you're doing larger projects, 179D, we have old rules and we have new rules. Okay, so some of the old rules, we're up to $1.80 per square foot. This is an additional tax deduction on top of what your depreciation is, and even on top of cost seg. We can layer cost seg and 179D. You can get both if you qualify. So this is an energy efficient deduction. So if you meet a certain energy efficient criteria on that new property, you can get up to $1.80 per square foot as a tax deduction. The new rules bump that up to $5 a square foot. Now, I know these percentages probably don't mean too much to you, and there is another webinar that's specific to that. So please check it out if you want to know more. But this is very, very interesting when, let's say, for instance, the 179D. Let me give you a quick criteria on the 179D. It's either commercial property that you newly constructed or substantially rehabilitated or did a rehab on, and then or it's multifamily that's 4 stories or more. Okay, that's the criteria for the 179D. So if you had a 4-story multifamily apartment complex, for instance, or something like that. Okay, so this is just touching real lightly on it. Old rules are $1.80 per square foot. New rules with lots of other criteria on there up to $5 a square foot. So if you have energy efficiency in those multifamily spaces, make sure that you're reaching out to us and we can chat. The 45L is specific for residential. Okay, so this would be single family homes typically don't do very well, but they can if they're built for energy efficient. So if you built a new home, this would typically go to the developer, not really the buyer of a new home, but the developer. If they do meet that criteria, you could probably negotiate with them a little bit. But really, this is for developers. Multifamily, the old rules were $2,000 per unit if you meet this criteria. But here's what's interesting about the 45L. That's a tax credit. 179D is a tax deduction. The 45L is a tax credit. And under the old rules, it would have to be 3 stories or less. Okay, so if you built your typical 3-story garden style apartment complex or something like that, that could be eligible for a $2,000 tax credit per unit. So that could be very, very interesting for that. And now the new rules for the 45L, this is 2023, right, and forward for both the new rules for 179D and 45L. These credits go up to $5,000 per unit. And there's a limitation where now you can do any high rise. You're not limited to the 3 stories, right? So there's some huge tax credits and tax deductions for these particular types of projects if you're developing to look into this and be able to utilize some of those deductions for your investments and for your other things that you want to do. Okay. One person asked, can this be used for new development? Yes, absolutely. The energy tax incentives are usually specifically for new development. So thank you for your question. And can this deduction be taken if the entity didn't make an income versus 179? If there wasn't income, they can still take the deduction. It just sits there as a tax asset and rolls over to the next year. So yes, you can do that. And thank you for your question, Garfield. Would we consider senior living as residential? Yes, I would. I would call that. There are some criteria depending on the length of stay. So keep in mind, but rule of thumb, yes, we can use that for residential. And we are doing 179D and 45L certifications as well as cost segregation studies. Can you build a new single family home and use this tax credit for yourself? Yes, if you are the developer and you're the one, you're the GC and you're developing and you're designing and it meets that criteria, then yes, you can use that tax credit. There does have to be a certification for that. So thank you so much for your questions, and we'll keep moving on to a little bit, one more slide on the 45L qualification. You can see the complexity of the new changes for the IRA bill, and we'll get into that on those 45L or energy efficient things later in the slides when we go on our website. Okay. So let me go back and just see, there's a couple other questions. Let's see here. 45L is multifamily only. No, you can do this on single family homes as well. However, they don't usually perform as well as multifamily. Multifamily, you have a lot more interior walls and less structure outside the building, which tends to change the qualifications a little bit. And hi Donnie, it's good to see you here. Thanks for joining our webinar. Does it include plumbing efficiencies that would be available to the plumbing contractor of a multifamily apartment complex? Typically probably not. I think it would, the rules are going to be very indicative of everything energy efficient: windows, doors, walls. Insulation is a huge factor. If you don't have, in the new rules, if you don't have the continuous rigid insulation, you will not qualify, period. So it's not just the plumbing efficiencies. So it's really everything in whole, and it would go to the overall developer for these incentives. So let's see, I have another question. If I have K1 income from an IT service company, can I use depreciation from real estate to offset that? If not, is there any other tax strategies you suggest? Yeah, Robbie, thank you so much for your question. This is really getting into more of your activity, if it's passive activity or active activity. And I think we have a more detailed webinar specific to that and cost segregation, and where the cost segregation actually can be utilized. So yes, we can help with that. So please reach out to us. And if a property was placed into service in a prior year, but the final CO is not achieved, can you still try for 45L in the tax year after the fact? Great question by an anonymous attendee. If you have it started construction in 1 year, but it wasn't finished or placed in service till the following year, the 45L goes by when the property was either leased or sold. So if you develop a property and then you sell it, you're, as the developer, will get the 45L for the year that it was sold. If it's an apartment complex and you lease it, then when it was leased is the trigger. So it's not even when the property was completed, but when it was actually leased or sold. That's the 45L. The 179D is a little different. That is upon the certificate of occupancy or the substantial completion date. Okay, so there's two different dates that we're talking about there. So thanks for your question. I love the Q&As, and sometimes I can get on and probably just do Q&A sessions, and I probably can't get to them all, but we'll definitely make sure that we have these written down, and we'll go back to them afterwards when we have the completion. But thank you for all the questions. Okay, we're going to switch gears over to the employee retention tax credits. This is something that each of you have probably been bombarded with 5,000 emails a day. That might be an exaggeration, it might not, or phone calls of people trying to do your employee retention tax credits. This is, it's a possibility up to $26,000 per employee retained that you retained through COVID. These are for 2019 or 2020 and 2021 quarters. And, there's different rules for each quarter, even throughout the year. You have to have a drop in revenue, or you had to have some sort of mandatory or partial shutdown, supply chain disruption issues. I mean, you could qualify for these employee retention tax credits. And by the way, if you're interested in any of these services, we do have them listed on our website, www.engineeredtaxservices.com. And under the list of services, you'll see the employee retention tax credits. We have a great application process, and we can help you through that if you're interested in doing that with, a reputable company. The employee retention tax credit, forever, I have a lot of clients that are reaching out saying that, hey, all my friends are getting this, why can't I have it? And we go through the application and realize that they're not eligible. Not everybody is going to qualify for ERC, okay? And there are a lot of companies out there that say that everybody was impacted by COVID and everybody qualifies, and that's just not the case. So make sure that you are going with a reputable company and not somebody that's just a pop-up company that isn't going to be here in a year to help you if there's ever an audit or something that goes on with that. Okay, so make sure that you're not using a company that only does ERCs, because it's going to be very difficult when these expire and these are going to go away, that they're even going to be in business anymore. So please don't be misled. Be very careful with who you choose as your ERC provider. And make sure that that company is a legitimate company and that they're going to be around when you need them, if you need them a little bit later. Okay, but these credits are super, super good. It's if you don't know whether you qualify, you should go through the process on our application and see what so what you would qualify for, because this is just a huge benefit to help help your business succeed as a result of having some troubled times through COVID. So a lot of companies do qualify, but there are some that don't. So please don't be misled. A lot of people are being taken right now. So okay, so I want to move on to research and development tax credits. These are more for businesses or companies that are doing research and development activity. There are both federal and state tax credits available for this activity. Even if you are pre-revenue, or if you don't have, say pre-revenue, or maybe in a loss situation, you can still benefit from tax credits like the research and development tax credit, because they're going to let you offset your FICA tax, right? If you're a startup company and you haven't had any gross receipts more than a year, you can actually offset your payroll tax. So if, like I said, pre-revenue or startup, these are some new rules that were part of the PATH Act of 2016. So don't think that you can't use the tax credit. You might be able to still use it. Part of the what's included, the types of things that are involved in the research tax credit, mostly this is a wage-driven credit. So it's the people that are involved in research and development activities. If you have manufacturing, you're manufacturing a product. If you're in IT, you're developing software. If you're developing apps, if you're an architectural firm and you're designing buildings, there's a lot of research and development that goes into those activities, among others. Food science, for instance. If you're I have a client that makes ice cream flavors, right? And just all kinds of good things. Those are those activities, who are involved in the research and development. It would be box 1 W-2 wages of those employees at 3 different levels. And we don't want to get into the weeds of this, but also subcontractors that you hire to help you with maybe some product testing or some development, and then also some supplies. And these are supplies that are used, consumed, and or destroyed during the R&D process. Those are the 3 elements of research and development. Who's a good fit? These are just some, the ones in yellow are kind of like no-brainers. The other ones are really good as well, but this is just a good picture of kind of what types of industries you can see would be a good fit for research and development. Research and development tax credits are very powerful. There's amortization now. There's a lot that's going into that, and we have a whole webinar on the amortization and how that's changing. But say you have, gross revenue might be $10 million, and you might qualify for a portion of that for research and development tax credits. And then a portion of that could be allocated, but that could be, $40,000 a year in tax credits, for that company. So it's small compared to other countries. Other countries actually, they subsidize their research and development, in some cases pay for it, but the research and development tax credit here in the US is still very, very lucrative and very important. So we also offer grants. Okay, so sorry, I'm sliding around on these. So moving from research and development to grants, the grants is something that we also help with. We have grant writers on staff, and grants, as everyone probably knows, is just free money. The grants that are available out there, it's very interesting that on a low federal, local, and even private grant level, if they don't give away the grant money that they were allocated to, they lose it for the following year. So, state and local companies love having these grants, state and local governments really love having their applications for these grants so that they can continue their funding and they can continue to facilitate businesses in their state or their local area. There's also federal grants. So these grants are out there for just about, any business, small businesses, especially minority-owned businesses. If you're a woman who owns a business, that in itself could qualify you for grants, free money, or even special loans, and we can help with that. Public housing organizations, anyone who's in low-income housing, affordable housing, senior housing, specific housing to maybe group homes, anything like that. Those, improvements can be funded. There's just all kinds of things you can do. There's educational organizations. If you're a school or you have an online university, if you have anything like that, you can certainly, qualify for some grants. For-profit organizations, believe it or not, you don't have to be nonprofit to qualify for grants. You can be for-profit, and also government organizations, right? So don't forget, if you have a business and you're actually focused in any of those places, if you're just a regular business and, you're really not doing anything to help your community, chances are the grants are a little bit slimmer. But if you have anything like in these sections that are listed, it really becomes an amazing tool to be able to help with, getting that free money to help fund those projects for you. Okay, so don't forget, we can also help with that. And again, we believe that everyone should pay tax, but there's nothing in the code that says you have to leave a tip. I know I've said it before, but for those of you who missed it, this is a really important statement, and I use it a lot because we know that there's all these incentives out there that can help us reduce our tax liability. And when we're not using them, we're leaving a tip on the table for the IRS, and we don't have to do that. So we're in the business of taking that tip off the table. So all of these tax incentives and more, this is just a very small sampling of the things that we can do to help reduce your tax or provide tax credits or funding to go back into your pocket. What can you do with that? Certainly you can go blow it, right? You can go spend it on, a new car or something like that. But really, if you're in an investment mindset, what can you do with that incentive? You fund your next real estate deal. Cost seg is such a powerful, especially bonus depreciation, has been so powerful that literally, has been able to catapult personally my personal wealth by, buying properties every single year and using that tax deduction to offset my W-2 income. My husband is the real estate professional in our family, and he runs all of our investment deals, and so those are very, very powerful incentives. And when we have tax deductions, very, very large tax deductions or refunds back, we get to use that money and we can go invest in our next real estate deal. We can also fund improvements, right, to your investment real estate. So let's say you did start at Airbnb and you want to finish out the backyard or put in a pool or a hot tub or something like that. You can use these cost segregation benefits to offset the renovations or the improvements. If you own a business, you have R&D tax credits. What can you do with an extra $40,000 or $50,000 a year? Maybe $300,000, $400,000, $500,000 a year. You can hire new employees to help you be more profitable. You can fund your next R&D project, right? Especially with grants. The possibilities are really endless. You can simply take the savings and reinvest it in wherever you see fit, wherever that makes sense for you. Purchase new equipment for your business to help you be more profitable. I mean, there's just endless possibilities to be able to use these tax incentives. And at this point, I think we're pretty good. I usually try to stop around 9:45 so I can answer the questions, and we've got a lot of questions, folks. So I'm going to use the next few minutes to go through some of these questions. I know I went through some of these services very quickly, but please note any one of those can be found as a more in-depth presentation on our website, www.engineeredtaxservices.com, and you can view more in-depth presentations on what I've shared there, and then also more. Obviously, this was just a sampling. So I'm going to go to some of the chats and also the questions. So if you want to stick around, and one of the questions is on 45L or solar panel installation. Solar panel installation is also available for investment tax credit at 30%. Typically, we don't need to do that because you don't need an engineer, so your CPA can get you that tax credit, but it is included in the 45L and the new 179D criterias. So that's very helpful. And I see that Daniel actually posted the webpage in the chat for any of you who want it. So I'm going to go to a couple, and so we might bounce around with topics, but we're going to go through some of the questions that we have here. How to use tax incentives to fund your next investment. Okay, so original title of webinar, funding. So funding is essentially with the grants, right? We can use the grants, we can use the tax credits. That's essentially what we're trying to achieve here by helping you with the possibilities. Okay, so I have a question here. In a 1031 exchange but in a 1031 isn't personal property depreciated, recaptured immediately, and not part of a rolled over gain into a new property, or has that changed? Yeah, so that's very interesting that you asked that question, Michael. So in the 1031 exchanges, yes, you do have to extract personal property, but the code, and this has actually been clarified by the IRS. They're talking specifically about FF&E, like furniture, equipment, like vehicles that were purchased, artwork, very valuable artwork that was purchased, or say if you have a hotel and you bought all the furniture with the hotel, that stuff is what has to be extracted. What we're doing in our cost seg studies is we're actually extracting the 1245 and 1250 property, and we're breaking all of that down. That 1245 property is called personal property, but it's actually installed in the property, so it's part of the property and is not included in the FF&E category. Okay, so yes, we do need to take out the FF&E, but we get to use the 1245. We don't have to pull that out of the 1031 exchange. That was a miscommunication by the IRS, which they came back about a year later and clarified that we're talking specifically about 1245 and 1250 property, which is the personal property that's actually installed in the home. The difference is like a chandelier, right? Let's say you put a chandelier in a hotel or in your home versus a couch, right? The chandelier is installed, the couch is just placed in there. Okay, so those are things that the difference is. So thank you for clarifying that question. Can the certification for the 179D be done by an engineer on this project, or is it better if a company like yours does it? Great question, Garfield. The answer to that is that the IRS does require a third-party independent engineer that's unrelated to the project. So if you had to design that, you're not going to be able to have them certify the 179D. So that's something that has to be done independent and third party. Okay, so Kip asked, so the 45L offsets the gain. The 45L is a tax credit. So it's not a tax deduction. It actually is going to come, it's a below the line credit. So let's say you get to the very end of your tax return and you say you owe $10,000, but you have $3,000 of tax credits. Essentially, you're only now going to owe $7,000. So it doesn't offset the gain. It's actually a tax credit. So it offsets the liability. The 179D offsets the gain. So there's a little bit of a difference there between the credits and the deductions. Okay, hopefully I'm answering these accurately. Hi, Jagdeep. It's so good to see you here. Thank you so much for joining us. Is there any hold period after using bonus depreciation on a new acquisition? Yeah, so, this is kind of what we were talking about with the recapture, where you want to use, more than just a hammer for building a house, right? So, I would say if you're going to hold the property for more than a year, for sure, but you want to have a tax strategy to be able to, if you're going to sell that property, get out from underneath the bonus depreciation or the recapture. So you use it as a tax strategy or a tax deferral while you can, and then you have a tool, whether 1031 exchange or whatever, to be able to go back into something else. And so really the hold period depends on how many tools in that tool belt you're using. Okay, so if you have a good plan and a tax strategy, then you should be just fine. Okay, Xenia, it's so good to see you here as well. Thank you so much for joining us. There will be a recording of this, and if you can't listen to the whole the whole webinar, or maybe even if you missed it, we're going to be recording this. It's going to be on our website. The whole series of possibilities is going to be on the website later. So thank you so much for joining and for your questions. How would an architectural firm take advantage of the research credits? Just an example, if you have one. Yeah, Chris, thank you so much for asking this. Architectural firms are very interesting and unique in that they are designing a specific building, and they're building systems having to do with that. So they're building usually a lighting system, or maybe they have a subcontractor that comes in and does the mechanical, or an electrical engineer, or plumbing, those types of things. And so those would be subcontractors, and depending on how those subcontractors are paid, the product, I guess the easiest way to explain it, the product to an engineering firm is the blueprint. That is their design. They own the design, they own the rights to that design. And usually you're not designing a building that is cookie cutter. You're not going to, do another one that's exactly the same. Anytime you're building a new or designing a new property, a project, it's new and challenging. And so not every project is going to qualify for R&D credits in that case, but there certainly are going to be some that are more challenging to your firm that, maybe somebody walks in your office and said, hey, please design me a double platinum LEED building. We don't see that very much anymore, but that as the case, it should be very challenging, or you're trying to overcome, some other challenges with a design. So those are the ones that it is built for. When you list design build, does that qualify for a property development company building its own account? Or not really. So yeah, if you have a design build firm and you're doing the design of the property development, you could qualify for some of these credits, because you're the one who actually designed the systems that create that facilitate the end result, right? So that's how that would qualify. Can a sole proprietor architect use R&D credits for exploring new design processes or writing green guidelines? It's possible, yes. Anytime you have, exploring design processes, research and development is for product or processes. So if you're going in and as mentioned before, you're designing this property or this building, and you're putting in a lot of effort into how am I going to make this work, or how am I going to make this maybe, net zero or something like that, whatever the client is asking you for, there's definitely challenges. Okay, so we should probably dig into that a little bit more for you. If you have questions, please go to our website. You can email me directly and I can help with that. Okay, how are grant dollars taxed for small businesses as regular taxable income? That's a great question. There are a lot of different grants out there. Some of them are just grants. Some of them you have to, claim tax on them. Some of them you don't. It really depends on the type of grant that you're going to be getting, whether it's local or federal. And so, some of them are subject to that and some of them are not. So be careful with those, and we can help you answer that once we get into digging into what you've actually got. Okay, so Scott, thank you for being here and for your question. He says, Cost Seg is great. I use them 100%, enough to help with down payments on new investments, but not enough to leverage one. Yeah, so Scott, thank you so much for your comment here. This is something that we use all the time. The coolest part in my mind, I think, with cost segregation is that when you buy a property for $1 million, you're not usually paying cash for that building, you're leveraging it. So basically, if I have to come up with 30% down of $1 million purchase, I put down $300,000, but then I can actually get the depreciation and the cost seg results based on the $1 million, even though we have a loan. And so, yes, absolutely, the cost seg is so helpful in offsetting, the gain or whatever investment was that you put into that property. So thank you for the comment there. How does the service of grants work at ETS? Do I need to identify the grant and ask you to submit on my behalf, or do you work with me to source available grants? Thank you for that question. And yes, we do work with you to identify the types of grants. We actually do a thorough, we have on our website an intake form that if you want to fill it out, it will give us a good idea of what your projects are, your business, or what you're doing. And then from there, we can set up a call to discuss what types of grants might be available and what our pricing is to actually get involved with you on a grant level. It's usually a monthly fee, and then until we get those grants obtained for you. So that's kind of how we work, but very helpful. We do everything from sourcing the grants to even helping with the counting on the backside, because there's some reporting that goes along with the grants as well. Can you speak a little more on the 30C and the EV chargers and if that's the best route? EV chargers, again, you get the tax deduction, the investment tax deduction for those, if you're including those into a property. And we're looking at everything energy efficient when we're looking at the 179D and 45L. If you're just doing EV chargers, you don't need us, you don't need an engineering firm to get the benefits, but you do end up having the ability to take those deductions, and your CPA can help you with those. But if it's part of a larger project, obviously we want to look at the 179D and the 45L to help. Okay. Okay, so someone says, my wife runs a house flipping operation. She flips 5 to 8 residential properties per year. Does ETS research and find grants for women-owned businesses, or does she need to bring a potential grant to ETS and they help her apply? So again, yes, we can help source those. But again, house flipping is one thing, but really is it specially geared towards a specific type? Is it, building it specific for a group home? Is it building it specifically for low income housing? That's going to be a key factor to the actually qualifying for grants, but just the minority owned business could also qualify. So really fill out the intake form and let's find out where we would put you and see what types of grants might be out there. And it also depends on your area. Okay, so okay, so Jimmy Jimenez, oh my goodness, thank you. I haven't seen your name for so long, but thank you for joining. And thank you so much for your questions. The recording will be on our website. And I think if you've registered, it should also send you a link to that. So keep an eye out for your email and maybe in a spam. And then we can go from there. So, okay. So, Zinni, I see you have a couple of pretty long questions. If you want to just email those to me that I can answer those personally, that would be very helpful. As Scott says, today's rates, not very many deals can cash flow. That's exactly right. We are finding some challenges in that. However, there is some loosening up of the financing that we're starting to see, and that's part of my reporting from the Real Estate Roundtable that's coming from the top. So hopefully that will start to loosen up a little bit more as well. So does or will a cost study take into account enterprise zone tax incentives? Enterprise zone, not so much. Opportunity zone, yes, there's a whole different opportunity zone piece to that. So that might be something that you can look into on our other webinars. Let's see, I'm trying to get through all of these questions. So. Okay, I think I've answered the most of them. If I didn't get to you, please email me directly. On the screen is my email address. Just copy and paste that question and send it over to me, and I'll answer those questions for you. I think I have a few more chats. There's a couple articles that Daniel posted. Thank you, Daniel. And I think we're pretty much answered the most of the questions. So I thank you for your participation. We actually are ending right on time. We have just 1 minute left. Please take note of my contact information. Reach out if you have any questions. I know we went through this information very, very quickly, but we wanted to kind of outline some of the possibilities that you can do with some of these incentives and where to find the resources. So again, thank you for joining. Please email or contact us if you have any further questions, and have a wonderful, wonderful day.